All right, guys, how's everyone doing? Paul Singh here with bullsonwallstreet.com. We're going to talk about the covered call strategy today, a very basic option strategy that is one of the best to create monthly income with high win rates. Now, this is a little introduction into what we're going to be going over in the Options Masterclass starting Sunday. Now, we are going to get into some very advanced concepts. This is a simple strategy here. But we're going to start from the beginning. The first day is just going to be an introduction. We're going to go over everything and build as the class goes on. It's going to be 5 or 6 sessions, and each one will build on the next. So even if you know nothing, you'll be okay. Let's get to it with the covered call strategy here. Now, again, even if you know nothing about options, this is still a strategy you can implement as a swing trader or investor. So it's an income-based strategy. Essentially, you're looking to hit a monthly expectation, whatever that is. As you swing traders know, it's difficult to get high win rates, but you generally want to be getting bigger wins. And you can go even, sometimes a month, 2, 3 months without really winning. Then all of a sudden you start hitting big, and that makes up for those months where you don't win. Now, some people need monthly income. That strategy doesn't work. That's where you can implement this specific options strategy. So the advantage again is a high win rate. You can even win when the stock is down slightly. Actually, the strategy we're going to go over today is a little twist on a common strategy where you can even win when the stock is down big. So you got a stock that's down maybe 10 points. You bought it at 100. If you're just generally swing trading and you bought 100 shares, you'd lose $1,000. Right? Well, we're going to create a strategy where you actually profit even if it's down a specific amount. So you can win when the stock's down slightly. You're basically collecting premium on that trade. Disadvantage, you limit your upside profit. You are capping the upside. So if you bought it at 100, the strategy we're going to create, maybe you'd profit up to 105. Anything above that, you don't get any more profit. So it's capping your upside. But the advantage again is you are getting a very high win rate. You're going to win essentially constantly with this trade. Another disadvantage, you are not protected from a big loss once the stock goes down below the break-even point that you have set. Now, we're going to go over a strategy where you can actually have really big losses and still profit. But even that, if it goes below a certain point, you start losing. So essentially, you buy a stock at 100. Let's say you set your break-even point at 80. You're essentially going to profit anywhere above 80, even though you got it at 100. But if it goes below 80, you start losing. And those profits can be pretty big if it were to go from, say, 80 down to 5 or down to 20, whatever it is. But what we're going to do is we're going to create a very big profit zone with the strategy we're going to go over today, to where even if the stock gap down pretty big, you're probably still okay and you're probably still winning. And because you're creating that cushion, you're going to get a very high win rate. So the general market, stock, or swing setup outlook for this, for the basic strategy that we normally use would be neutral to slightly bullish, and that allows us to keep more upside. We get to cap our gain higher. Again, the strategy I'm going to go over today, we're going to use a very big win zone, but it's going to be the downside, and we only profit a little bit. So essentially, we're going to get a very high win rate and some smaller wins on this. So let's go over exactly how to do it. Now, the strategy, if you were going out of the money, and out of the money is when your strike is above your stock price. You're essentially creating a bearish play with that, but only slightly bearish. So we won't go over the specifics of creating the out of the money covered call, but just know here, with the scenario listed here, you can go ahead and read this here. Essentially, we're buying 100 shares of a stock at 100 and then selling a call at 120, which is your strike price, for $6. That's your premium credit. That's what you're capturing, you're getting right away. Now, in the class, we'll go over more specifically what all this means. We don't have time to do it here in the video. But here, essentially, what we've created is a scenario where we give ourselves a 4% cushion. So essentially here, if the stock were to go down to 96, we're profiting anywhere above that. So essentially the stock could go down 3 points and we're still making money on the trade, whereas a normal swing, you'd be down $300 if you had 100 shares. And your potential profit is 26%. Because essentially here, the stock could go up to 120 and we're still making a rising profit. Anything above that level, and we start capping our gain. Now that is with the out of the money. Now let's talk about in the money. And again, there's a lot of terminology here that you won't know yet, but you'll understand in the class. Here is the exact strategy. With the in the money call, we're going to essentially, or in the money covered call, we're going to buy 100 shares of a stock. Essentially, we're bullish on the stock. And then we're going to sell one call with the strike price this time below the stock price. So essentially here, we have both price value or intrinsic value, and we have time value or extrinsic value, which is what an in the money call is. And again, we'll go over the terminology in the class. But for this scenario, we buy 100 shares of a stock. Again, let's say the stock is trading at 100. We buy 100 shares of it. Now we are going to sell that call at 80. The strike is going to be 80 for $25. You can see here, we're paying more for it. We were paying $6 in the previous scenario. We're paying $25 here. That's because there's more value in the money, so it's going to cost us more. But we're getting something for that. So let's see exactly what we're getting here. You always want to calculate your max loss, your break even, and your max profit in these trades. Your max loss is your stock price minus the premium credit, what we were paying here, the $25, times 100. So essentially, there's a big potential loss here. So 100 minus 25 equals 75 times 100. You could potentially lose $7,500. You're not going to. The stock would have to go to zero. Essentially, you're buying it at 100. Stocks usually are not going to go to zero. It's probably not even going to go to 50, right? So even though we've calculated a max loss here, it really doesn't mean a whole lot. Now, the break even is very important. And that break even is essentially this 75 here. It's your stock price minus your premium credit. So just take that 100 minus 25, and that is 75. So what that is telling us, and this is what's really important here to know, when you buy that stock at 100 and then you sell that call at 80, in this scenario, the stock can go down to 75 and you're still going to profit from the trade. And that's why you have a very high win rate. It's very hard for the stock to go below that. I mean, it can happen, but it's going to be pretty rare that your stock is going to go below 75. So you're mostly going to be winning. Occasionally you're going to lose. Maybe the stock goes down 70, 65, you end up losing. But most of your trades are going to end up winning. So here we've created that huge cushion. We know the stock can go down to 75 and we're all right. Now, to calculate our max profit, we're going to take our strike, which was 80 here, minus the stock price, which was 100, plus the premium credit, multiply that by 100. So here, I took the premium credit first here, but 80 plus 25. So 80 is the strike, plus 25 equals 105, minus 100 equals 5, times 100. So essentially here, we're going to win $500 most of the time. So most of the time you take this trade, you win $500. Now, if it goes below 75, you start losing, right? So if it goes down to 70, you would lose $500. If it goes down to 60, you would lose $1,500. So when you think of that in terms of risk reward, you can lose a lot more than what you're gaining, but you're going to win so much on this trade that it's a really good setup for income. You're very rarely going to go below 75, and you're going to win most of the time. So essentially, you take this trade over and over again, and you're winning 500 times each time you trade it. So we've given ourselves, where in the previous scenario, we gave ourselves a 4% cushion and a 25% potential gain. Here, we have a 25% cushion down to 75. We're only getting a 5% gain on that $100 stock. We're only gaining $5. So that's a 5% gain. But again, we are going to win over and over again. And these things can be manipulated depending on where your strike price is, how much you paid for the premium. A few things you should know when you're trading this. When we trade it in the money, which is the style we went over here, most people are doing it out of the money. But in a neutral or bearish market, the in the money will actually work well. Gives you a lot of downside protection, but caps your gain a lot. And we just saw that. We could only make 500. So essentially, it's like the stock going from 100 to 105. Even if it goes down to 80, we're still making, it's like it went up to 105. It was just a normal swing, if you want to think about it that way. Caps your win even more. This is a big advantage in the sense that you're getting this huge cushion, this huge win zone, essentially. But remember, you're giving up potential profit on this. When you trade this specific setup, the in the money, you want stocks with a high implied volatility and a higher time premium. These are concepts we'll go over in the class if you guys aren't familiar with this. But essentially, you want a lot of premium because premium is what's going to get you that $400 or $500 that you could potentially win. And we'll talk about that in the class. I don't have time to talk about that here. But just know that find stocks that have high implied volatility, and there's charts you can do to look at that. If it doesn't have a high implied volatility and you're not getting good premium on it, you don't want to take the trade. So that's a little introduction here into some of the stuff we'll be going over in the class. Starts Sunday. There should be a link in the notes here for you to potentially sign up. So, all right, guys, talk to you soon.